Hello, everyone, and welcome back to another Velocity Channel episode on Velocity Banking, making sure that you eliminate your bad debts and create your wealth. So today we have a question that is very, very exposing, all right? And this is a very good question by Bobbity, and I want to get right into it. So I don't know if you're going to agree with this point of view or not, all right? But I want to give this to you, and I just want to submit this to you, all right? Look, Bobbity says, you totally left out the fees, saying don't worry about them. Seems to me it makes more sense to just use my bank account for my mortgage. Definitely no fees there. Okay, definitely no fees there. No fees, huh? No fees. I tell you what, let's just go ahead and see if that's the case. Roll that beautiful bean footage, Biz Friend Fretcher. Folks, that looked like fees to me. Matter of fact, over $226,000 worth of fees. Okay, that's interest that's going from you. Notice what I said in the past few videos. We've gone over and over it, and that is, if you don't understand interest, you're bound to pay it. But if you understand interest, you're bound to earn it. And so remember, they never taught you in school that sometimes 6 is not less than 21. At least when it comes to interest. It's up to you to ask the question, is this amortized interest or is it simple interest? Because that's the difference between Celsius and Fahrenheit. So which one is colder? 5 degrees or 6 degrees Celsius or 32 degrees Fahrenheit? Anyone know which one's colder? 32 degrees Fahrenheit. Why? Because Celsius and Fahrenheit are calculated differently. And that's what the banks have done to you. They told you that, hey, 6 is less than 21. Right? You useless eater, right? That's what they told you. But they didn't. They failed to tell you that amortized interest is greater than simple interest and how they calculate it and how they have those scheduled payments and they have amortization tables and anything with the word mort in it equals death. Always remember that. Mortuary, mortgage, that's death pledge. You'll pay till you die. Morticia, right? Mort. The end. And we don't want that. What we want for you is to make sure that you're not paying as much in fees and in interest than you have to. So with that, we want to go ahead and take an example, right? Seems to make more sense, Bobbity says, to just use my bank account for my mortgage. Let's see what happens when you use just your bank account for your mortgage, all right? Hey, we know that you have more than that, okay? We know that you probably have a savings account. You got a big old IRA or whatnot, right? So we got the checking and the savings account, okay? And everything is hunky-dory until you find out, man, I got to split this pie. Now, you got a car, right? You got a vroom, and let's just go ahead and write the word car, all right? You got a card, okay, meaning credit card. Let's just write the word CC, okay? Then you got groceries to pay. That'll be represented by a paper bag. You remember when groceries came in a paper bag? And that's the groceries coming out of there. Huh? And then what do you have? You got a big old mortgage, and that'll be represented by the house. All right. So let's say you have $1,200 in the mortgage, right? You spend $600 on the groceries, $600 on your minimum payment credit card, and of course $300 on your car. Look at that. So 1,200 plus 600 equals 1,800. 1,800 plus 600 equals 2,400. 2,400 plus 300 equals 2,700. Okay. Well, guess what? Okay. Now you're making $5,000, right, in income, and you're at 2,700, right? That means you've got 1,300 or 2,300 left over. That's awesome. But because you're a good saver, you're going to put that 2,300 right there. Bing. So how much is your cash flow? 0. You don't have time for emergencies, do you? But let's say this credit card, right, that you have a $12,000 balance on, okay, but you have a $15,000 limit. Let's say we were to use the credit card as our new checking account. What would it do to this minimum payment on the credit card? It would cross that out. Why? Because when you're using your credit card as your new checking account and $5,000 is going into that $12,000 balance card, you no longer have a minimum monthly payment, but you have, watch this, $600 in cash flow. Marker drop. Just like that. You no longer have to worry about a minimum monthly payment when it comes to that credit card. Why? Because you have drunk the Kool-Aid. You are now in with the crowd of velocity bankers that say, you know what? There is a way out of debt. There is a way I can eliminate debt and at the same time build wealth. And you did it already. So now you have what it takes to change a tire, right? It's not a catastrophe. That catastrophe, right, is now transformed into an inconvenience. We transformed that $600, right, that minimum monthly payment, we transformed it into cash flow. And we do the same with loans. We transform amortized loans into simple interest. It's all about transforming. Okay? That's what it's all about. Now, I can go through the rest as well, but I think you get the picture. Let's use the 15 grand. Let's use the lines of credit. That's why they gave it to us. It's not our money anyway. All right? Let's use other people's money to grow our wealth. So let's go ahead and do that. Stop segregating your cash. All right? No, it's not segregation now. It's not segregation ever, right? Consolidate. Instead of doing a debt consolidation, a consolidation loan, do a consolidation line instead. You get yourself a line of credit. And you know what's even better than that? A First-Lien HELOC. Ooh, that's another level. Go ahead and check it out in the description below, that First-Lien HELOC. If you need one, go ahead and check out the class as well. Go ahead and get educated so that you can teach others the velocity banking method as well, okay? God bless, folks. Like, share, and subscribe, and we'll see you on the next video.